The company behind Tylenol just got bought for nearly $50 billion. But here's the twist. Most people had written them off completely just weeks ago. Their stock had tanked almost 30%, lawsuits were piling up, sales were falling, and then, out of nowhere, Kimberly-Clark swoops in with a massive rescue deal. But this isn't just another corporate merger. This is about the medicines in your cabinet, the Band-Aids in your drawer, the baby shampoo you grew up with, brands that feel like part of your life. And they were on the edge of a cliff. Because while everyone assumed these household names were safe bets, the company selling them was anything but. So how did Kenvue, this spinoff from Johnson & Johnson that owns some of the most trusted products on earth, end up needing a bailout? And why did Kimberly-Clark think it was worth nearly $50 billion to save them? Let's talk about it. All right, quick background. Kenvue is basically Johnson & Johnson's kid. J&J decided in 2023 to split off its entire consumer health division, everything from Tylenol and Listerine to Neutrogena and Neosporin, and let it run independently. They called it Kenvue. The name's a mashup of knowledge and view, which honestly sounds like corporate word salad, but whatever. The point is, this wasn't some scrappy startup. This was a company born with $15 billion in annual revenue and brands people have trusted for decades. But here's where it gets interesting. Being born with famous parents doesn't guarantee success. And Kenvue, they've had a rough childhood. The company went public in May 2023 at $22 a share. It popped briefly to almost 28, and then it just bled. By late October 2025, the stock had fallen to $14. All-time lows, down almost 30% year to date. Investors were panicking. Activists were circling, and the company was scrambling to figure out what went wrong. So what happened? Why did a business with Tylenol and Band-Aid, products that basically sell themselves, struggle this hard? Let me break it down. First, sales weren't growing at all. In fact, they were shrinking. The most recent quarter showed revenue down about 3.5%. Their biggest segment, self-care, that's the Tylenol and allergy meds, down 4%. Skincare, down 5%. Essential health products like mouthwash and baby care, also down 3%. Nothing was working. And when you're a consumer health company, flat sales are a death sentence. You need growth. You need innovation. You need people buying more of your stuff, not less. But the real killer, the lawsuits. Specifically, the Tylenol lawsuits. In late September, President Trump made a wild claim that Tylenol causes autism in pregnancy. Completely baseless. No scientific backing. But it didn't matter. The stock tanked 7.5% in one day. Then a few weeks later, the Texas Attorney General filed an actual lawsuit against Kenvue and J&J, accusing them of hiding those same risks. Now, to be clear, the medical consensus says acetaminophen, the drug in Tylenol, is the safest pain reliever for pregnant women. But lawsuits don't care about consensus. They care about headlines. And suddenly, Kenvue's biggest moneymaker was under fire. The FDA even said they'd revisit acetaminophen warnings just to be safe. Investors freaked out. You see where this is going? Within weeks, Kenvue stock dropped another 20%. It hit $14, the lowest it had ever been. People were calling it uninvestable. But here's the part most people miss. While the stock was cratering, something else was happening behind the scenes. Activist investors were quietly buying in. Funds like D.E. Shaw, Third Point Value, Starboard Value, they were building stakes, big stakes, around 3% each. These guys don't throw money around for fun. They saw something the market didn't. They saw brands that still dominated shelves. Tylenol is basically synonymous with pain relief. Listerine owns mouthwash. Neutrogena is everywhere. And yes, sales were down, but these products weren't going anywhere. People still needed them. The question wasn't if Kenvue's brands had value, it was whether anyone would step up to unlock it. And then, on November 3rd, someone did. Kimberly-Clark, the company behind Kleenex, Huggies, and Cottonelle, announced they were buying Kenvue for $48.7 billion, $21 a share, part cash, part stock. The stock exploded, up 14% in a single day on massive volume. Those activists who'd been nursing losses, they basically broke even overnight. The deal was their exit ticket. Hey, quick checkpoint on our quest for profits. If this breakdown's on point, hit like, subscribe, and ring that bell so you don't miss out on the next quest. Let's keep hunting smart plays together. All right, back to the video. Now let's talk numbers, because this is where it gets really interesting. Kenvue was trading at a massive discount to its peers. Like, the kind of discount that screams something's wrong here. Its forward price to earnings ratio was under 15. Compare that to Procter & Gamble at 20. Its price to sales was about 2, half of P&G's 4. On paper, Kenvue looked cheap, but cheap for a reason, right? No growth, legal risks, a dividend that was paying out more than the company was even earning. That's not sustainable, and the market knew it. So Kenvue was stuck. Too risky to be a safe income stock, too slow to be a growth play, just limbo. But Kimberly-Clark saw an opportunity. They're betting they can take Kenvue's brands, plug them into their distribution network, cut about $2 billion in costs through synergies, and turn this into a $32 billion consumer health empire. If it works, they'll have brands covering literally every stage of life. Baby products, personal care, pain relief, skincare, hygiene. Cradle to grave, basically. Pretty wild, right? But there's still risk here because those Tylenol lawsuits, they don't just disappear when Kimberly-Clark signs the check. They inherit them. And if those cases blow up, if there's some massive settlement or the FDA slaps a scary warning label on acetaminophen, that's going to hit the combined company's bottom line hard. Then there's execution risk. Merging two giant corporations is messy. Culture clashes, redundant jobs, integration headaches. Kimberly-Clark is promising those $2 billion in synergies, but actually delivering them? That's where things can go sideways. And if they don't hit those targets, the deal starts looking a lot less brilliant and a lot more like an expensive mistake. Oh, and one more thing. Kimberly-Clark's stock dropped 14% the day they announced this. Their own shareholders weren't thrilled. Some think they overpaid. Some think the timing's bad. Some just don't want to own a company that's now on the hook for Tylenol's baggage. So while Kenvue shareholders got a lifeline, Kimberly-Clark shareholders are wondering if their company just bought someone else's problem. Here's my take. If you already own Kenvue, holding makes sense. You're basically locked into that $21 buyout price, maybe a bit of upside if Kimberly-Clark's stock recovers. There's your quarterly dividend while you wait. And assuming the deal closes in late 2026, like they're saying, you'll convert into Kimberly-Clark shares. Not a bad outcome considering where this stock was a month ago. But if you don't own it yet, I wouldn't rush to buy. You're essentially betting on Kimberly-Clark at this point, not Kenvue. And if that's the play you want, you might as well just buy Kimberly-Clark directly. Kenvue's fate is sealed. The upside's capped. The story's over. This was a turnaround that never got the chance to turn around. A spin-off that stumbled out of the gate and couldn't recover on its own. And now it's being folded back into something bigger, hopefully stronger. So yeah, while everyone was chasing the next AI darling or meme stock, this quiet drama was playing out in the medicine aisle. The maker of Tylenol, Band-Aid, and baby shampoo, brands we've known our whole life, almost became a cautionary tale. A reminder that even beloved products don't guarantee a safe stock, that lawsuits and headlines can crater billion-dollar companies overnight, and that sometimes the rescue comes not from within, but from a bigger player willing to make a very expensive bet. Will it work? We'll know in a year or two when we see if Kimberly-Clark can actually pull off this integration and prove those synergies weren't just PowerPoint promises. But for now, Kenvue's independent chapter is closing. And honestly, after this year they've had, a lot of shareholders are probably just relieved someone showed up with a check. That's the story. A household name in crisis, a $48 billion rescue, and a reminder that in markets, nothing's ever as safe as it seems. And hey, I hope this video helps you on your quest for profits. Get you on the next one.